Hello everyone. We want to thank you for joining us today for our workshop. We have Tom Brand here. He is the director of our risk management group here at FirstWest. His topic is titled Piercing the Corporate Shield, How Your Liability as a Fiduciary May Be Leaving You Exposed. Tom Brand has had over 18 years of experience as a commercial insurance producer and risk management consultant. His clients have ranged from startup companies to clients on the Forbes list of America's largest private companies. Specializing in commercial risk, Tom has a wealth of knowledge with regard to protecting the business interests of his clients on all levels of risk management. He works hard to stay abreast of developments in the marketplace and to build a partnership between carriers and clients to maximize efficiencies of their risk management insurance programs. Tom attended Utah State University and the University of Utah. He received his CIC Certified Insurance Counselor designation in October of 2001 and is actively seeking his CRM Certified Risk Manager designation. He joined FirstWest in 2012 and heads the risk management department. When Tom's not at home, he enjoys spending time with his wife and 3 children. He also enjoys serving in his church, coaching Little League sports, and serving with the Boy Scouts of America. As we do this presentation, if you have any questions, please type them in the questions box on your webinar control panel, and I will present those questions to Tom and he can answer them. The webinar slides will be available after the presentation. Without further ado, here's Tom.
Thanks, Chanel. Welcome, everybody. I'm excited to share with you some ideas here today about fiduciary liability. It's not necessarily the most exciting topic in the world, but hopefully, well, I can't guarantee it'll be fun. Maybe it will be insightful and educational. Let's see here. We get this. There we go. So I wanted to just first of all outline briefly what we're going to discuss today. I wanted to talk about a brief history of fiduciary liability, the evolution of the regulatory scope of the different departments that have to do with the regulation of ERISA and some of the fiduciary liability surrounding that, the responsibilities that you have as a fiduciary, what some of your exposures are, how to mitigate those risks, and then talk about some risk transfer options for you. So where did fiduciary liability begin? Well, as our financial industry continued to evolve, we began to become experts really in financial product offerings, and the advisor and the consultants were born, and also as employers were working hard to attract and retain key people to their businesses, they began to offer different kinds of benefit plans, pension plans, retirement plans, and other benefits. As the administration burdens increased on the employers, they began to look to experts to help them in those realms. And obviously, as anything having to do with financial items does, fraud, misrepresentation, and errors and omissions began to occur. So lawsuits began to fly around, and both plan advisors and employers were held responsible for those things. This little cartoon just emphasizes the fact that it seems like any time we come up with a new idea, something innovative, there's always regulations that have to be implemented to protect the people involved. So just to continue this, the EBSA, the Employee Benefits Security Administration, enforces the reporting and the disclosure of the provisions of ERISA. And we're going to talk a little bit more about what ERISA is in the next few slides. Initially, it was just the IRS that was regulating private pension plans, but in 1959, when the WPPDA Act was passed, the Department of Labor became more heavily involved, and what this act did is it required sponsors to file plan descriptions and annual financial reports with the government, and it also required them to make those plans available to plan participants and beneficiaries too. So it wasn't just going to the government, but the participants and the beneficiaries needed to know what were in those plans as well. And the purpose of this was to help educate plan participants and the beneficiaries and make sure that all of this was done on the up and up, which brings me to my next cartoon here. This guy on the left says, "This fiduciary thing, he really complicates exploiting my job to get stinking rich." There are crooks out there, but not all of it is always a misrepresentation or fraud. A lot of this stuff can happen from errors and omissions as well, and we'll talk a little bit more about that. This picture is President Ford, Gerald Ford, actually signing ERISA into law in 1974. What is ERISA? It is the Employment Retirement Income Security Act of 1974. And again, the purpose here is to protect the interests of plan participants and their beneficiaries. It requires the disclosure of the plan details, and then also civil enforcement assures that funds are protected and benefits paid. And we'll talk a little bit more about ERISA bonding later. So Title I ERISA administration today is divided amongst the Department of Labor, the Internal Revenue Service, and the Pension Benefit Guaranty Corporation. And as products in the marketplace have continued to evolve, there's been a lot of evolution as well on the regulatory side of this. You can see in this long list of different acts that have come out of, since the inception of ERISA. You can see COBRA in there. You can see HIPAA in there. And then at the very end, you can also see the Affordable Care Act. So ERISA has broadened its scope and really has its tentacles into just about any kind of plan you can imagine nowadays as far as benefits go. So so it leads us to the next question here. Who is a fiduciary? The Boston University Law Review gave, I thought, what was a great definition of this. They said, what generally sets the fiduciary apart from other agents or service providers is a core duty when acting on the principal's behalf to adopt the objectives or ends of the principal as the fiduciary's own. So translation of that, when you are acting as a fiduciary and you're making decisions about plans and the benefits for plan participants, as a fiduciary, you should do what would be considered in your best interest if it were your own money or your own benefits. So I thought that was a great definition. It's important to understand that it's not a title that necessarily designates you as a fiduciary. The status of a fiduciary is based on the functions that the person performs for the plan and not just their title. So we've got a couple of different comparisons here. On the left, you can see that these are typically considered fiduciaries, and on the right, typically not considered fiduciaries. So look at the list and ask yourself, are you involved in any of these things? It can be a person or an entity, plan sponsor. It can be the administration committee, the board of directors, the trustee, an investment advisor, and this is a critical bullet point, all individuals exercising discretion in the administration of the plan. Okay, so that's a pretty broad net. Typically, stockbrokers, insurance agents, and real estate agents are not fiduciaries, and then you'll see my little asterisk there. When attorneys, accountants, and actuaries are acting solely in their professional capacities, they're typically not considered a fiduciary. So what is your exposure? If you found yourself on the column on the left and you're a fiduciary, what do you have to worry about? Well, let's ask some more questions. Does your company offer health insurance plans, unemployment insurance benefits, or 401k, or stock option or preferred executive comp plans. If you offer any of these things, then your company is a fiduciary, okay? And then anybody who's administering that is also considered a fiduciary. These next bullet points are to ask you maybe a risk assessment of your own company. In particular, the next one, think back to the last recession in 2008. There were so many people that just got out of the 401k. A lot of them closed their plans out, and a lot of people lost quite a bit of money in investment during that recession. So has your company ever decreased the value due to a drop in the stock market? We saw that significantly during that time, and there were a lot of fiduciary claims that came out of that period of our history most recently. Does your company administer any of these plans in-house, including clerical work or paperwork to enroll employees in these plans? And in selecting outside investment advisors to your administration of your pension plan, how did you choose that advisor? Did you try to get professional advice in doing that? Did you consult ratings or recommendations? And we're going to discuss that a little bit further. Just because you hire a third party does not necessarily mean you are not considered a fiduciary. You still have a fiduciary duty and obligation in the choice that you make for a third party administrator. So in short, if your organization offers benefits obtained through a plan such as a pension or insurance, more than likely it's going to fall under the scope of ERISA and subject to ERISA law. We've got a couple of these spread out through here, but I wanted to give some real life claim examples of fiduciary. So these were claims on fiduciary liability policies. Okay, so this is an example of a group of employees that allege that their newly selected outside plan administrator improperly delayed transferring fund balances in the plan from one investment option to another as directed by the participants. So subsequently, the employees sued the plan trustees to recover more than $1 million in lost investment income. And the defense costs alone were $250,000 for that. So not only was there a judgment against them for the loss of income, but there were $250,000 of defense costs that were included in that claim. Now, this is an example of a company hiring a third-party administrator to do this, but still being held liable because of their position as a fiduciary, even though they've selected a third party to do that. So who is responsible? We know that the entity who's providing the benefit, the plan sponsors, is obviously the corporate liability side of it, but there's also a personal liability as well for anybody who is helping in the administration of those plans. Under ERISA, there can be personal liability for alleged breaches of fiduciary obligations, okay? Certain corporate actions that affect plan assets can and will be held to be fiduciary functions under ERISA. A lot of times when directors and officers come on, the bylaws and of the corporation incorporate language in there to protect. They're going to indemnify these directors and these officers, but sometimes they're not able to. The corporation isn't able to actually protect its officers, and so not only are they held responsible personally by ERISA law, but the corporate shield may not be able to respond in a way that's going to protect them and indemnify them for their actions. So it's a critical risk to consider whenever anybody's offering any kind of a pension or benefit plan, that you as a fiduciary personally your assets could be at stake. So what are your liabilities as a fiduciary, and what can you do to limit them? Well, first of all, it's really important to understand what your responsibilities as a fiduciary are. In the next few slides, most of this information, by the way, I got off the government's website, Department of Labor, and the IRS, and so this is information that if you wanted to do more study, you could go out and look and understand it more. But fiduciary responsibilities, according to the government website, says that acting solely in the interest of plan participants and their beneficiaries, and with the exclusive purpose of providing benefits to them, and then also carrying out your duties prudently. So that means following a plan document, diversifying plan investments, and paying only reasonable plan expenses. So what exactly does that mean? What does it mean to act prudently? Well, first of all, I guess I want to go to the plan. What is a plan? So under Title I, ERISA, a plan is required to include certain key elements, all right? And that includes a plan document. You've got to have some kind of a document on file at your place of business that describes what the plan does, what are the benefit structures, and the guided, the day-to-day operations of that plan. This includes, defined contributions, different classes, when the plan begins, when it ends, and those sorts of things. And we're going to talk a little bit later about how this one item in ERISA and your responsibility to it is one of the leading causes of fiduciary claims. When the plan document either A isn't implemented or B has not been changed as your plan evolves over time. Also, the plan has to have a trust fund to hold plan assets, a record-keeping system to track and flow the monies that go in and out of that retirement plan, and then documents to provide plan information to employees participating in the plan and to the government. And again, this is, just to reiterate again, this is like a benefit enrollment guide or those kinds of things that go out so that in layman's terms you can understand as a participant what exactly it is that you have, how it operates, and what you can expect the performance of it. So, and again, that responsibility is to your employees, and it is also to the government. So here's my prudent slide. There's a difference between being prudent and a prude. So what does it mean to be prudent, to act prudently as a fiduciary? One of your essential responsibilities is to basically use common sense. It requires expertise in a variety of areas such as investments. So if the fiduciary, if you don't have the expertise required, then you really should hire someone with that professional knowledge. In addition, prudence focuses on the process for making fiduciary decisions. Okay, so this is critical to understand that there's a focus on the process itself in the decision making. So it's wise to document the decisions that you make as a fiduciary and the basis for those decisions. For instance, in hiring any plan service provider, a fiduciary may want to survey several potential providers, asking each for their same information and providing each the same requirements, thereby documenting the process and the decision. This documentation of your process and your decision making is one of the key risk mitigation practices that you can do for fiduciary liability. It can help deflect a lot of that when and if anything comes, any allegations come against you for not acting in a prudent manner. And that includes everything from plan changes to advisor changes and everything else. You really should try to document those in minutes and file those to protect yourself. Following plan documents, I alluded to this earlier. Following the terms of the plan document is also an important responsibility. The document serves as the foundation for the plan operations. So employers will want to be familiar with that document, and especially if it's drawn up by somebody else, by a third party. Typically, that's how it's done. For a pretty minimal cost, you can have somebody draw up a plan document for you. But that needs to be reviewed. A lot of times what will happen is you'll pay a third party to do it. You'll get the plan document, that's based on the information that you've provided to them about your plan. And a lot of times that'll just get thrown into a file somewhere, and either it's never looked at or it doesn't get looked at again. So it's critical to keep that updated and refer to it and be familiar with what's in it. For example, if a plan official named in the document changes, the plan document must be updated to reflect that change. So again, this is a critical risk mitigation practice if you just keep your plan updated. And then also you have an obligation to be prudent in diversifying your plan investments. So plan assets should be diversified. This is really common sense to minimize the risk of large investment losses. Fiduciary should consider each plan investment as part of the plan's entire portfolio. And once again, fiduciaries will want to document their evaluation and investment decisions. This is a concept that I think a lot of fiduciaries misunderstand. If you have knowledge of another co-fiduciary either breaching a responsibility or concealing the breach, or you conceal that breach and you don't bring that to, you don't take steps to correct it, then if that person is caught, you are also going to be caught and named as a co-fiduciary with them. So you're going to share the responsibility of the actions of the people that serve as fiduciaries on the same plan with you. So it's critical for you to do your due diligence, that you train and that you discuss with each other, that you've got some practices in place in case something goes awry and you need to get it fixed. Everybody, there should be transparency there and open and honest communication to reduce that risk. Here's my second claim example. There was a legal action brought by employees alleging the wrongful elimination of a profitable investment option. So basically, they had their investments in a fund that was operating really well, was performing really well, and for some reason, the outside investment manager arbitrarily decided that they were going to move funds out of that and into another investment fund, and which wasn't also approved by the plan participants, and it ended up costing quite a bit of money. So they sued, and defense costs again on that were $358,000 just to defend that, and then $500,000 in damages. So again, this is an example of a third party making a decision, and the fiduciary liability coming back to the plan sponsor. So we've talked quite a bit about what it means to be a fiduciary, and it's a little bit scary, kind of like Dracula here, right? The blood-sucking stock investment companies. And here you are standing as a fiduciary trying to protect plan participants, and it can be a pretty daunting task, but we have some tools, and we've talked about them a little bit before, but we can help you mitigate risk. So officers and directors really should be sensitive to any transaction that has any direct effect on plan assets or on the rights of plan participants. So again, anytime that you're sitting around and you're thinking about changing benefits, changing plan providers, doing anything that's going to affect your plan participants in any way, you need to take extra precautionary steps to make sure that you're prudent in your actions, that you've documented everything, and that those decisions are made really in the best interest of your plan participants, going back again to the definition from the Boston Law Review of what a fiduciary is, that you're going to act as if that money were your own and that those benefits were your own. So you want to document all of the processes, uses, and how all those decisions are made on all of those plans. If you can, you want to set up as much plan participant control as you can. Nowadays you've got the option with 401ks where I've got a login and a password, and I can go in on my own and take those investment dollars, and I can diversify them into any of the available funds there for me. I'm the one who's making that decision, not the plan sponsor or even the hired third party to do that. And that deflects some of that liability from you as a fiduciary. Hire service providers to handle fiduciary functions and set up agreements so that liabilities are transferred to those providers for contracted services. Now, this does not necessarily deflect 100% of that fiduciary liability, but if you can contractually transfer some of that risk over onto the shoulders of those third-party contracted service providers, then that will, obviously that will help mitigate some of the risk that you have. And then regularly monitor contracted managers and advisors to assure plan investments are handled prudently. I can't tell you how many times you've got a third-party advisor that comes in from any number of the myriad of companies that are out there, and you see them a lot of times once a year at plan renewal. That's really just not enough, and you've got to see those people more often. You should be looking at how the plan is performing, and then documenting those meetings that they've taken place, and recording any minutes from them. And then also, I alluded to this earlier, every single plan that offers a 401k needs to have an ERISA bond. And an ERISA bond is to protect 10% of the plan assets. Typically, those are written you can get them on a 3-year term, and it's about $100 a year. So imagine, you get a bond, you're compliant now, it's going to protect 10% of the assets. You pay $300 once, and you don't have to touch it again for 3 years. It's extremely inexpensive, very easy to do, and we have that as a turnkey product offering here at FirstWest. So one of the other critical ways that you can transfer the risk of fiduciary liability is through a fiduciary liability policy. And before I get into this contract language just a little bit, I wanted to explain how this is sold. A lot of times you can get a director's and officer's liability policy, an employment practice liability policy, and a fiduciary liability policy together in a product suite offering. And you can silo those limits so that you can have them each have their own limit, or they can share a combined limit together. And they're all underwritten separately. There are different questions that they ask about your fiduciary, and a lot of it has to do with what we've gone through in these previous slides. Are you documenting things? What plans are you offering? How much of the assets? Who are your team members? Those kinds of things. But when you do get a fiduciary liability policy, this is some of the stuff that it covers. This is actual contract language from one of our carriers that we use. One more thing I want to point out before I get into this just a little bit. You can see in here that some of the words are bolded. And anytime in an insurance policy when you see bolded words or you see words that are italicized or in quotation marks, that's the carrier saying, I know you think that this means insured plan, but we have a unique definition for insured plan, what that means to us and what that means by this contract. So keep that in mind anytime that you're reviewing anything insurance related, that the definitions are critical to understanding how the policy will respond in a claim. So a wrongful act, this means any actual or alleged error, misstatement, misleading statement, act, omission, neglect, or breach of duty consisting in a violation of any responsibilities, obligations, or duties imposed upon fiduciaries of an insured plan by ERISA or any similar law. So that's pretty broad language. Breach of these responsibilities, obligations, or duties imposed upon an insured by HIPAA in connection with an insured plan. Okay, so HIPAA violations there. If someone alleges that you've breached an obligation or a duty there's coverage. An error or misstatement, a misleading statement, act or omission, neglect, or breach of duty in counseling, providing interpretations, handling records, or affecting enrollment, termination, or cancellation of employees or participants. So think about your HR department here. You've got somebody that comes in and says, Bill, I don't know which one of these plans I want. What would you do? I don't I don't get it. So right here, you're going to step into a counseling, role, and you're going to be providing interpretations and helping them understand the plan. So that's critical to have coverage for that. And then the last one, a matter claimed against any an insured solely due to such insured acting in the capacity of a fiduciary of an insured plan. Okay, that last sentence there is kind of the broad safety net that incorporates really all of the risk involved as a fiduciary and in transferring that risk. So again, it's fiduciary liability policy is a great way to transfer the risk. Obviously, there's a premium involved in there, but underwritten and based on a lot of different things when they look at that. So just to sort of sum everything up that we've talked about here, these are the top 5 reasons that your organization and you as an individual should consider purchasing a fiduciary liability plan. Number 1, a fiduciary can be personally required to make the plan whole for any losses that they caused. We talked about that earlier. The corporate shield does not always protect the fiduciary. Sometimes by law it can't. So it's critical, number 1. Number 2, defending and resolving ERISA suits costs a lot of time and a lot of money. Now these are national averages here, but the average settlement is it's almost $1 million, $994,000 average defense cost. That's the settlement, and then the defense costs are $365,000. This figure really is amazing to me. The 69% of substantive, I guess that's an inoperative word there, but substantive ERISA litigation is resolved in favor of the plaintiffs. That's well north of half of all of the suits that are brought. So obviously, ERISA was enacted originally to protect plan participants. So they're aggressive on that, and 69% are going in favor of the plaintiffs who bring these lawsuits. Not all of those are true. There was one slide that I actually did not include in this, but there was $1 million summary judgment that was against a plan where they had some landscape people that were part-time and really not eligible for the benefit plan, but they brought a lawsuit, and it cost the insurance company $1 million to defend it. But there was a summary judgment in favor of the plan sponsor, the employer. So not always does it go in favor of the plaintiffs, but even in that example, there was a significant amount of money that the insurance company had to pay to defend their client. So without a fiduciary liability policy, that would have cost the company $1 million just to try and get out of it. So number 3, you cannot avoid liabilities solely by blaming plan participants for their investment decisions. Since 2006, the plaintiff's bar has recovered more than $170 million for excess expenses. Number 4, fiduciary can be sued for not following plan documents, and plan participants regularly sue, claiming denial of benefits in violation of those plan documents. So remember, part of the ERISA law is not only do you have to provide those plan documents to the government, but each of the plan participants has those documents as well. So they should know, and it's in an effort to educate them what their plan is, how it should be performing, what it should do for them. So they know this, and they bring those lawsuits on a regular basis. More than 9,000 ERISA lawsuits are filed each year on average. And again, most of that is coming from, most of the liability is absorbed in the failure to maintain a plan and keep it up to speed. And finally, the 5th one here, a fiduciary cannot escape responsibility by blaming a service provider. According to the Department of Labor, it is the responsibility of the fiduciary to vet and monitor any outside vendor. We've talked about that quite a bit today. So again, these are the top 5 reasons to purchase a policy. We've talked about mitigation and risk transfer. Document. That's really, really critical to do. And you as a team of fiduciaries, you need to get together on a fairly regular basis, and especially any time when you are considering manipulating any part of your benefit offerings to your employees. You've got to be very, very sensitive about that. You've got to document that process, and you've got to act prudently in the best interest of your plan participants. And if you can do those things, as scary as being a fiduciary might seem to be with all the regulations, there is a fiduciary liability zen that you can reach. You can purchase these policies that will help transfer that, and you can put into place your risk transfer and mitigation methods. So with that, I don't know if there are any questions from anybody. We'd love to visit with you and answer any questions offline. And looking forward to being of service to you.
Thank you, Tom. Like he mentioned, if you do have any questions that you think of later, you can contact Tom at tom.brand@fwbs.com, or you can give us a call. We also have several other departments here at FirstWest. We do group retirement plans, HR consulting, benefit consulting, and wealth management. So if you have any other questions about those, you can reach out to us through our website or giving us a call. We will be hosting this workshop tomorrow live in Salt Lake and Provo. If you are interested in attending that, just let us know. We will send you these slides, and we hope you have a good afternoon.